Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I am your host, Matt Sands, and I'm here to help you make the most of your minerals and royalties. And Justin Williams is here with me. Hey, Justin.
Hey, Matt. Thanks for having me as always.
Thanks for coming on the show to represent the individual mineral owner. And today we're covering mineral rights news for May 2020. It's definitely been an eventful month or 6 weeks or so in terms of news with respect to the oil and gas industry. And this month was no different. We have some things in terms of what's coming for the industry as a whole and really interesting articles this month. So we'll just go ahead and dive in. Justin, what do you think?
Let's do it. Let's dive in. No lack of news, that is for sure. So our first story here is owners see decline in offers for mineral rights. The article begins by saying the coronavirus had a devastating effect on the oil and gas industry. With supply greatly outweighing demand, prices have fallen drastically. In a situation that can have a dramatic effect on the value of mineral rights, lower prices means less revenue. However, many companies are still making offers to buy or lease minerals. Comments here, episode 4, how mineral rights are valued. Basically using the cash flow method, you forecast future royalties and discount them back to a certain date, and that lump sum amount is the value of the property. Main drivers of value are timing, commodity prices. Impact of lower crude oil prices means lower royalty checks, as we are now starting to see with checks hitting mailboxes around the country for production in March. Also impacts what companies expect prices to be in the future and what future royalty payments will be. Lower crude oil prices also mean operators are not drilling new wells. If you have undeveloped acreage, new wells drilled in the future can make up a significant portion of the value of the property. Because of the time value of money, if you have permitted wells that are expected to be drilled in the next year or so, now we are looking at a situation where those wells may not be drilled for years into the future, if ever. This also is a situation where the reserves category that the operator places these in probably change from proved reserves to probable or even possible because they just aren't economic to drill at the current prices. This is why operators have big write-downs and also informs mineral buyers' buying decisions. If they don't expect a well to get drilled in the next 5 years, that is part of the proved reserves category, then much lower due to the time value of money and possibly additional discount they place on the future cash flow due to the increased risk that it won't get drilled. And this is why we're seeing the lower valuation. And I'm sure you could talk on that some too, Matt.
Yeah, it's really why we're seeing these offers for mineral rights a lot lower now than they were 5 months ago. Obviously the price of oil has dropped significantly from around $60 a barrel at the beginning of the year to now around $20 a barrel. If you think of it today, we have crude oil prices are at about a third of where they were at the beginning of the year. And so it would stand to reason that if you were to run the valuation on the same property, that it would likely be worth about a third today, all things being equal if you just change the commodity price. Now, compounding that, like Justin referred to, the situation you get into is when mineral buyers are placing value on properties, they're looking at the potential for that property to have new production coming online in the future. And so that's where they're going to get the return on the investment. So they're looking at buying properties that are just ahead of where operators are going to drill next so that they can get that return on investment in a specified period of time. And usually they want to see that within the next year or so. And now we're in a situation where instead of standing up new rigs, operators are laying down rigs. Every week we see the statistics dropping in terms of the number of rigs that are running. And I would expect that to continue to be the case as long as we see price of crude in the $20 to $30 range, which I would expect that it will be there until we see a significant uptick in demand. And so what that means right now in practical terms is if you need to sell, you need to look at weighing the upside potential of that property in the future when prices recover versus the need for cash today, because ultimately you're going to sell the property at a potential discount to what it would be worth, a couple of years from now, if the prices do recover back to 40, 50, $60 a barrel. And so something to keep in mind. And, it's just really the tip of the iceberg as we see the industry starting to slow down. It's going to result in a definite buyer's market for mineral rights. And I would expect that we're not going to see a lot of leasing as well. So this article refers to the offers and purchase offers. And, I would expect the similar story to play out as it goes with leasing, just because operators aren't in a position to drill new wells with low prices. So, and then hopefully things will recover here soon.
Absolutely. Got to love the return on investment. Rule number one in business.
That's right. All right. Well, I'll dive into the next article here. And this one is from the Financial Times. It talks about the pandemic crisis offers glimpse into oil industry's future. And this article talks about the idea that due to the coronavirus pandemic, the demand shock could accelerate the peak of global oil demand. So there's this concept, and I'll take a step back before we dive in global oil demand peaking. And there's this peak oil scenario where you would see oil production peak at some point in the future. And then from there on into the future, it's going to continue to decrease. And so this article is speculating that peak could occur sooner than later. And it quotes, "The oil industry was already changing," says Mark Lewis, global head of sustainability research at BNP Paribas Asset Management. "The question is now whether this accelerates after the pandemic." And they also mentioned the fact that both BP and Shell have declared in recent months that their goals are to become a net zero carbon emitter. So basically, uh, the thing that we can infer from that is that they're going to be focusing more on opportunities to invest in projects that are not going to have significant CO2 emissions. And that would stand to reason that that would mean renewable energy. And, if that does happen, if we have this scenario right now with low oil prices, those renewable projects are actually going to become competitive relative to oil and gas projects. And the article quotes Mr. Lewis again and saying the old argument that you can't generate the same returns from renewables as you can from oil and gas looks increasingly weak. And the article has an interesting graphic. Suggests that you go and check it out. It's pretty interesting. Has It's a pretty lengthy article and covers a lot of this in more depth. But the particular graphic, there's a chart that shows the value creation of oil and gas projects as compared to wind and solar projects. And I don't know the time period that they did the analysis, but they show what they call recent projects, and they had a value creation which they define as the net value as a percentage of capital expenditure ratio, which they showed as over 100 for oil and gas and around 30 for wind and solar. So, $60 oil, we're looking at oil and gas being a clear winner in terms of where you'd want to spend your investment dollars. But now with $20 oil, you're not going to get the same return on investment. So what they're forecasting for future projects was where both oil and gas and wind and solar provide the same value creation at the 30-point mark. So really interesting to think about the fact that it actually, even though oil prices are low, it may actually spur a more rapid development of some of these renewable energy projects. And, I don't think oil is going anywhere anytime soon. We're still going to depend heavily on oil and gas for the modern conveniences that we enjoy in the developed world. Electric cars are great. And I think that that's definitely something that is going to increase, but they still use things like plastics and components that rely on oil and gas to produce. And so I do also agree that the article mentions the fact that publicly traded oil and gas companies have come out of favor over the past few years. And the sector is definitely underperformed the rest of the S&P 500 in the U.S. if you look at U.S. oil and gas companies. And so, there's this increased appetite also for more social and environmental responsibility in terms of where investors are, and I'm not just talking about retail investors, but banks and large investors as well, looking at spending money there that's more socially acceptable and not so much in the oil and gas space. And so, if you think about it from that as a headwind that the industry might be facing as well, that all those things, if you're going to spend a dollar and get the same return between an oil and gas project and a renewables project, but you're going to have a lot more political support for the renewables project, it could lead to certainly some of these larger companies, at least, starting to direct more of those dollars towards the renewable side of things. Now, I think the argument in the graphic they show in this article, as far as the value between oil and gas and wind and solar, is a relevant argument from an electricity generation point of view. So, that's sort of one thing that you could make a relatively easy switch. Obviously, there's other issues around reliability, and having, if you have solar panels out and it's dark out, it's not going to be generating electricity, but there's ways around that. But then when we talk about jet fuel, we don't have electric planes, so we have to fuel them with jet fuel. We still have things like plastics and polymers and pharmaceuticals and other consumer goods that are made with hydrocarbons. And so for those things, that's not going to change anytime soon. But some of these other opportunities that are out there from an investment point of view could be seeing more interest if they're renewable in nature. So interesting article. What do you think, Justin?
Yeah, and I don't think it's a huge surprise. For the last few years, it's been pretty obvious that the bigger players they have a facet focused on the renewable energy. So just kind of makes sense for them to look into that at a time where oil and gas may be iffy.
That's right. Well, let's go ahead and cover this last article here.
Let's do it. So, our last article here from the good old home state of mine, the Texas Railroad Commission will consider an oil production cut that is too late to matter. The article talks about Railroad Commissioner's draft solution brought forward by Commissioner Sitton to restrict production in the state of Texas in response to the drop in oil demand. It says in brief, the proposed order would establish every operator's October 2019 Texas production volumes as a baseline and limit their production moving forward to 80% of that amount each month. Operators whose overall volumes were less than 1,000 barrels of oil per day in January 2020 would be exempt from the requirements. Violations of these requirements would be punishable by a fine of $1,000 per well. And since the article was published last week, Texas Railroad Commissioner Ryard Sitton was interviewed on Bloomberg TV. And Monday, May 4th, he said, "I think oil proration is dead now, and that we have probably missed our opportunity to lead on this." So it sounds like oil production cuts being considered by the Railroad Commission are dead in the water at this point. And like mentioned in the recent episode of oil price episode, this would have been just a symbolic move at this point, since it would have been too late to make a difference on what operators are actually doing now due to the market forces. It just goes to show that political entities like the Railroad Commission, they just can't respond quickly enough to the changing market conditions. And at the end of the day, operators are going to do what's in their best interest. We will link to the interview with Commissioner Sitton in the show notes, as he mentions some interesting things about fragmentation in the industry, and that the small oil and gas producers are likely to be the losers once the market recovers. He also mentions the U.S. will use global market share once things recover, and I agree with this assessment. Matt, you want to talk a little bit about that?
Yeah, he mentions that he thinks that the U.S. is going to be the big loser out of this in terms of the market share. And so, what he's referring to is, as a lot of these smaller producers go bankrupt, we're going to see a lack of capacity in the system in the U.S. And so, what that means is we'll have fewer companies out there that are drilling wells. And so, at the end of the day, we may see larger operators that are the ones that are still going to be investing into shale plays once prices recover. And in the meantime, we're going to see countries like Russia and the Saudis and other OPEC nations that are going to be stepping in to ramp things up again once prices recover. They are weathering the storm. It's just a hit to their balance sheet as a country, but then they can recover and ramp production back up. Whereas in our case, if we get too much damage to the industry as a whole, we'll have people that are leaving the industry going into other industries. So if you had somebody that used to be working in the field in West Texas, there's no jobs there now. Now they're moving, they're doing construction, and maybe they move to another state or somewhere else. And so when things pick back up, they may not go back to oil and gas. And so there'll be fewer qualified people to do the work, less investment dollars going in. And this is just my opinion, really, but I think that that's what he's alluding to, and the fact that a lot of these small oil and gas producers are going to go out of business, and they're just going to leave a bit of a void there, and that void is going to be filled by other countries, not other companies within the U.S. So I hope that that's not the case. I hope that we are resilient. The one thing I will say is the industry has seen downturns like this before, and we've come out stronger in each case. And I do think that's going to be the situation here. It just means that it's going to take some time to recover from this. And in the meantime, we could lose some market share globally. But, that said, we are also the largest producer before this all happened. And so you think about it from that standpoint, we've come a long way over the past 5 years, and we could come back and regain that in the future. But it's just in the short term, I think we will end up losing some of that global market share.
I agree, Matt. And it trickles down to millions of people who are affected by this, and truly hard workers that now have to look for something else. So I agree with everything you've said, but as always, America will recover from it.
We will recover. And, it's like Warren Buffett said this past weekend. I watched part of the Berkshire Hathaway annual meeting. And so he had a really good quote there that I like, and maybe we'll just end with that. And it's, never bet against America. And I totally agree with that. So on that, we'll wrap up this month's episode of news. If you come across an article you'd like us to cover, you can send it to feedback@mineralrightspodcast.com. We'll have links to these articles in the show notes at our website, mineralrightspodcast.com. And you can also find it in whatever podcast player you're listening to this on. We should have links there as well. Thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.